The shock event. Market dislocation, not volatility. The collapse in silver prices did not unfold like a typical market sell-off. It arrived with speed, scale, and a lack of warning that immediately separated it from ordinary volatility. A 30% decline in a single session is not a correction. It is a rupture. And when such a rupture occurs in a market as historically thin, leveraged, and emotionally charged as silver, the event itself becomes a signal. The first mistake made by casual observers was to treat the move as an overreaction to news. Headlines pointed to easing fears around Federal Reserve independence and shifting political signals in Washington. But price action of this magnitude does not emerge from reassurance. It emerges from stress. Markets do not collapse because confidence is restored. They collapse because something beneath the surface fails to hold. Silver occupies a peculiar position in the global financial system. It is not merely a commodity, nor is it treated with the same reverence as gold. It is an industrial input, a speculative vehicle, and a quasi-monetary asset all at once. That hybrid identity makes it uniquely sensitive to changes in liquidity, leverage, and trust. When silver moves violently, it is often reacting not to one variable, but to a fracture between several. The comparison to 1980 has been tempting but misleading. That period was defined by inflation panic, monetary chaos, and overt attempts to corner the market. Today's environment is different in form but similar in structure. The stress is not visible in consumer prices or headline inflation metrics. It is visible in balance sheets, derivatives exposure, and the quiet mechanics of market plumbing. The decline was not driven by sellers making a judgment call. It was driven by forced behavior. In modern commodity markets, price is less a reflection of physical supply and demand than it is a function of positioning. Futures contracts, options, exchange-traded products, and synthetic exposure dominate daily volume. Physical silver barely trades relative to the paper claims written against it. This creates a system that appears liquid until it is tested. When margin requirements change or counterparties reassess risk, liquidity evaporates instantly. The speed of the drop suggests such a test occurred. Margin calls do not negotiate, they liquidate. When leverage is unwound, price becomes a byproduct rather than a signal. The market does not ask what silver should be worth. It asks what must be sold to satisfy obligations. In those moments, correlation spikes, bids disappear, and historical reference points lose relevance. What made the event more revealing was not silver's collapse alone, but the behavior of adjacent assets. Gold declined, but far less dramatically. Mining equities barely responded in either direction. This divergence is critical. In previous bull phases, mining stocks exaggerated moves in the underlying metal. Their operating leverage amplified gains and losses alike. That amplification was absent here. The absence of leverage response suggests a deeper shift. Mining companies are no longer treated as simple proxies for metal prices. They are treated as credit instruments, capital-intensive businesses exposed to financing conditions, regulatory risk, and cost inflation. When capital becomes cautious, operating leverage turns from an asset into a liability. Investors stop chasing upside and start pricing survival. This reframes the silver collapse entirely. Rather than signaling the end of a bull thesis, it signals a repricing of risk within a leveraged system. The market is not rejecting silver's long-term relevance. It is questioning the structure through which silver is traded, financed, and stored. That distinction matters enormously for decision makers. Business leaders and investors who view this as noise will miss the message. Extreme one-day moves are rarely isolated. They tend to mark transitions. Sometimes they mark the end of excess. Other times, they mark the beginning of constraint. In both cases, they expose assumptions that had gone unchallenged. The key insight from this event is not that silver fell, but that it fell in a way that bypassed narrative. There was no gradual distribution, no orderly repricing. There was a snap. Snaps occur when systems under tension reach their limit. The calm explanations follow later. The structural consequences unfold over time. This first phase, the shock phase, serves one purpose. It forces attention. It tells serious observers that the rules governing price discovery may no longer function as expected. And once that possibility enters the equation, the question is no longer what happened yesterday, but what cannot be assumed tomorrow. That is where the real analysis begins. Gold's decline and the illusion of policy stability. Gold S decline in the same session as silver S collapse was immediately interpreted as a sign of restored confidence. Markets were quick to conclude that easing fears around Federal Reserve independence had removed a key support for safe haven assets. In surface terms, the explanation appeared coherent. In structural terms, it was incomplete. Gold does not trade primarily on inflation or interest rates in moments of systemic stress. It trades on credibility. When confidence in monetary stewardship wavers, gold prices rise not because policy is loose, but because policy is doubted. Conversely, when markets are reassured, whether legitimately or cosmetically, gold often retreats, even if underlying conditions remain unchanged. The policy signal from Washington functioned precisely in this way. Announcements, personnel speculation, and institutional messaging were interpreted as stabilizing forces. The market did not require proof of independence. It required the appearance of continuity. In modern financial systems, perception often precedes verification. Gold responded accordingly. However, the scale and context of gold's decline matter. The metal did not collapse, it softened. This distinction is critical. Gold's pullback was orderly, suggesting discretionary selling rather than forced liquidation. That behavior contrasts sharply with silver AES disorderly decline and reinforces the conclusion that different forces were at work. This divergence highlights gold's evolving role. In the current cycle, gold functions less as a hedge against consumer inflation and more as a referendum on institutional trust. Central banks, sovereign wealth funds, and long-duration capital do not trade gold tactically. They adjust exposure when the perceived reliability of monetary governance shifts. Short-term reassurance can therefore produce short-term weakness without invalidating longer-term demand. Another layer of complexity lies in the distinction between physical and paper markets. While futures prices declined, reports of sustained physical demand persisted. Central bank purchases did not reverse. Retail and institutional accumulation outside Western exchanges remained stable. This disconnect suggests that gold-S price action reflected financial positioning rather than a fundamental change in ownership preference. Paper markets respond quickly to narrative. Physical markets respond slowly to structure. When the two diverge, price becomes an unreliable guide to underlying intent. This is not a new phenomenon, but it becomes more pronounced during periods of policy signaling. The easing of fear does not eliminate risk. It merely postpones its recognition. The illusion of stability is a recurring feature of late-cycle monetary environments. Authorities emphasize continuity, markets accept reassurance, and volatility subsides temporarily. Yet the mechanisms that generated instability remain intact. Debt levels do not fall, leverage does not unwind evenly, structural imbalances are managed, not resolved. For gold, this creates a paradox. Short-term policy reassurance weakens the price, but long-term structural uncertainty strengthens its rationale. Investors who conflate the two risk misinterpreting tactical moves as strategic reversals. Gold's decline in this episode should therefore be read not as a verdict on its relevance, but as a reflection of the market's preference for reassurance over confrontation. The contrast with silver sharpens this interpretation. Silver was forced lower by mechanics. Gold was guided lower by narrative. One reflects stress, the other reflects confidence management. Together, they illustrate how modern markets compartmentalize risk. For business leaders, the lesson is subtle but important. Markets can appear calm while absorbing strain. Policy signals can suppress visible volatility without strengthening foundations. Assets tied to confidence may retreat, even as systemic fragility increases elsewhere. This phase of the story is not about gold losing its role. It is about understanding what gold is responding to and what it is ignoring. When reassurance drives pricing, silence becomes more informative than headlines. The next layer of analysis lies beneath both metals in the structure of the markets themselves. That is where leverage, counterparty risk, and the true cost of stability reveal their influence. To understand why silver collapsed while gold merely softened, it is necessary to move away from price charts and into market structure. Modern precious metals markets are not governed by physical exchange. They're governed by leverage. What trades day to day is not metal, but claims on metal, layered, rehypothecated, and financed through complex derivatives. In silver, this structure is especially fragile. The physical market is small, inventory is unevenly distributed, and futures volumes routinely exceed available supply by orders of magnitude. Under normal conditions, this imbalance is invisible. Contracts roll, margin remains adequate, and price discovery appears functional. Under stress, the imbalance becomes the market. Leverage is the accelerant. Futures contracts allow participants to control large quantities of silver with minimal capital. This creates efficiency in calm periods and instability in volatile ones. When price moves sharply, margin requirements adjust. Those adjustments force participants to either post additional capital or liquidate positions. The decision is rarely discretionary. It is mechanical. The 30% decline bears the signature of such mechanics. It reflects not a collective reassessment of silver's value, but a cascade of forced exits. Once liquidation begins, price ceases to convey information. It becomes a clearing mechanism. The market is no longer asking who wants to buy or sell. It is asking who must. This is where the concept of market plumbing becomes relevant. Beneath visible trading lie clearinghouses, collateral agreements, and counterparty exposures. These systems are designed to manage risk, not absorb shock. When volatility exceeds modeled assumptions, they tighten rapidly. Liquidity vanishes, not because participants disappear, but because permission to participate is withdrawn. Silver breaks first in such environments because it sits at the intersection of speculation and scarcity. Gold benefits from central bank ownership, deeper liquidity, and a more conservative investor base. Silver attracts momentum, leverage, and tactical positioning. When the system tightens, silver absorbs the adjustment. Mining equities reveal another dimension of this fracture. In prior cycles, miners amplified metal moves due to operating leverage. Rising prices expanded margins exponentially. In the current environment, that leverage is impaired. Costs have risen, financing is constrained, and investors treat miners as balance sheet risks rather than price proxies. The result is a market where the metal can move violently while the equities remain inert. This is not a sign of health. It is a sign that capital no longer trusts the transmission mechanism between price and profitability. Leverage exists on paper, but it no longer translates into confidence. Counterparty risk further complicates the picture. In heavily intermediated markets, trust is the lubricant. Participants assume contracts will be honored, collateral will be sufficient, and liquidity will be available. When stress events occur, these assumptions are quietly reassessed. Exposure is reduced not because failure is certain, but because it is conceivable. This reduction does not make headlines. It shows up as lower participation, wider spreads, and abrupt price moves. The market becomes thinner precisely when it needs depth. Extreme daily moves are the visible consequence of invisible caution. The fracture point, then, is not a single level on a chart. It is the moment when leverage stops amplifying opportunity and starts amplifying risk. In that moment, markets cease to behave proportionally. Small triggers produce outsized responses. Stability becomes conditional. For decision makers, this environment demands a different lens. Price signals are distorted by mechanics. Volatility reflects structure more than sentiment. The absence of panic does not imply the absence of danger. It implies that danger is being managed procedurally rather than emotionally. Understanding this dynamic is critical because it reframes future risk. Once leverage is questioned, it does not return quickly. Participants demand higher margins, shorter tenors, and greater transparency. These demands tighten markets structurally, even if prices recover. The silver collapse, viewed through this lens, is less an endpoint than a revelation. It exposes how much of the market's apparent stability was dependent on uninterrupted leverage. When that leverage falters, the system adjusts abruptly. The final question is not whether markets will stabilize, but on what terms. For businesses and investors alike, the answer lies in how capital responds when mechanical support gives way to strategic caution. The events surrounding silver and gold are often misclassified as market stories. In reality, they are capital stories. They reveal how liquidity behaves under pressure, how confidence is managed, and how risk is redistributed when leverage becomes constrained. For business leaders and entrepreneurs, the relevance lies not in predicting metal prices, but in understanding what these movements signal about the broader financial environment. The first implication concerns capital preservation. In periods where price discovery is distorted by forced activity, traditional risk models lose reliability. Volatility spikes are not warnings of excess, they are symptoms of fragility. Businesses that assume continued access to cheap financing or stable hedging instruments may find those assumptions invalidated without notice. Capital becomes more selective before it becomes more expensive. Second, input costs and supply chains must be viewed through a new lens. Silver is embedded in electronics, energy infrastructure, and advanced manufacturing. Violent price dislocations, even if temporary, complicate procurement strategies. Suppliers respond to volatility by shortening contract durations and widening margins. This shifts risk downstream, forcing businesses to absorb uncertainty previously managed by markets. Third, the divergence between physical assets and financial representations has strategic consequences. When paper markets dominate pricing, companies relying on derivatives for risk management may discover that hedges behave unpredictably under stress. Instruments designed for efficiency can amplify exposure when liquidity contracts. This does not render hedging obsolete, but it demands a reassessment of counterparty concentration and contract structure. Financing conditions represent another critical channel. Mining equities? Muted response to metal volatility reflects a broader trend. Investors are prioritizing balance sheet resilience over operational leverage. This mindset extends beyond commodities. Capital-intensive businesses across sectors face higher scrutiny. Access to funding becomes contingent on stability rather than growth potential. Expansion strategies built on optimistic capital markets assumptions may need revision. There is also a psychological dimension. Policy reassurance can suppress visible fear while encouraging complacency. When markets accept narrative stability, businesses may delay necessary adjustments. History shows that such delays increase vulnerability when conditions change abruptly. Strategic caution exercised early is less costly than reactive adjustment imposed later. For entrepreneurs, the lesson is not to retreat, but to recalibrate. Opportunity does not disappear in constrained environments. It shifts. Firms with strong liquidity, flexible cost structures, and diversified funding sources gain relative advantage. Those reliant on leverage, narrow margins, or continuous refinancing face asymmetric risk. The silver episode also underscores the importance of temporal perspective. Short-term calm following a shock does not equate to resolution. Structural tightening unfolds over quarters, not days. Businesses that align strategy with this timeline are better positioned to navigate transition. Those that anchor decisions to immediate price recovery risk misalignment. Finally, these dynamics invite a reassessment of what constitutes safety. Assets traditionally viewed as hedges may fluctuate for reasons unrelated to their long-term function. Conversely, stability in some areas may mask accumulating pressure elsewhere. Strategic decision-making in such environments requires synthesis rather than segmentation. The overarching message is not alarmist, but pragmatic. Markets are adjusting to constraints that were previously obscured by leverage and confidence. This adjustment process is uneven and often counterintuitive. Understanding its signals allows leaders to act deliberately rather than defensively. What distinguishes resilient organizations is not prediction, but preparation. The events examined here offer a preview of how capital behaves when assumptions are tested. Those who internalize these lessons before they are enforced by circumstance retain agency. Those who do not are left reacting to outcomes they did not anticipate.